Traders spend years learning patterns that mean nothing, but this zone right here changes everything. It's so stupidly simple, it's obvious, and once you see how price reacts to it, you'll never trade the same way again. In this video, you'll learn exactly how it works, how to use it, and a step-by-step strategy you can start trading today. So step back, clear your chart, and start taking notes. So what is this concept that flips everything you thought you knew about price action? It's simple. Every move in the market creates imbalance. Price surges too far in one direction, then snaps back the other way as traders react. But sometimes those two opposing moves collide and create something rare, a moment of balance. That moment leaves behind a zone where both buyers and sellers fought for control. It's not random. It's where the market temporarily agreed on value before choosing its next direction, and that zone becomes a magnet for price. It's called a balanced price range, or BPR. Once you can spot these zones, everything changes. You start to see structure where others see noise. You stop guessing where support or resistance might form and start watching the exact areas where smart money is active. At this point, you might be wondering, what can balanced price ranges even do to my trading? Well, three things actually. First, they show you exactly where institutional activity happened, both buying and selling aggression in the same area. Second, they give you precise entry points with clearly defined boundaries. Third, they filter out noise so you are not chasing every setup, only the zones where the market has already proven balance. In this video, we're breaking down everything: how to identify a balanced price range, how to add the indicator that spots these ranges automatically, and a simple step-by-step strategy to trade them with surgical precision. Let's dive in. Now that you understand the idea behind a balanced price range, let's break down how it actually forms on your chart. A balanced price range is a specific zone on your chart where two opposing fair value gaps overlap. To understand that, we need to quickly cover what a fair value gap, or FVG, actually is. It's an area where the market's perception of fair value suddenly changes. Think of it as a zone where price moved too quickly for both buyers and sellers to trade evenly. On your chart, it appears as a three-candle pattern, a large candle in the middle with smaller candles on each side that don't fully overlap it. For a bullish FVG, you'll see a strong green candle between two smaller ones. The top of the first candle and the bottom of the third create a small gap. That gap shows where the fair value has shifted higher. When price later dips into that area, buyers often step in again and price tends to rise. For a bearish FVG, it's the same idea in reverse. A strong red candle forms between two smaller ones, and the gap between the bottom of the first and the top of the third marks where the fair value shifted lower. When price climbs back into that zone, sellers often step in and push it back down. Now here's where balanced price ranges come in. When the market creates a fair value gap in one direction, let's say bearish, and then immediately creates another fair value gap in the opposite direction, in this example bullish, the area where these two gaps overlap becomes a balanced price range. Think about what's happening. Price makes an aggressive move down, creating a bearish imbalance. Then price makes an aggressive move up, creating a bullish imbalance. The zone where both of these imbalances exist, where they overlap, is where the market found a temporary balance. Both buyers and sellers showed aggression at the same price points. That makes it significant. Why does this matter? Because when price returns to a BPR, it tends to react strongly. Smart money traders recognize these zones. They see them as areas where previous imbalances were neutralized, where opposing forces met, and these zones frequently act as support in uptrends or resistance in downtrends. But not all balanced price ranges are the same. You need to understand the difference between bullish and bearish setups. A bullish BPR forms during a pullback in an uptrend. Price drops aggressively, creating a bearish FVG. Then the price reverses sharply upward, creating a bullish FVG. The overlap between these two is your bullish balanced price range. When price pulls back to this BPR during the uptrend, it often acts as support and provides a high probability long entry. A bearish BPR is the opposite. It forms during a retracement in a downtrend. Price rallies aggressively, creating a bullish FVG. Then price drops sharply, creating a bearish FVG. The overlap is your bearish balanced price range. When price retraces to this BPR during the downtrend, it often acts as resistance and provides a high probability short entry. Now, identifying balanced price ranges manually can be tedious. You've got to spot fair value gaps, track their boundaries, and then identify where opposing FVGs overlap. That's where this tool becomes handy. This indicator does one thing perfectly. It automatically identifies when two opposing fair value gaps overlap and highlights the balanced price range for you. No manual drawing, no second guessing. It scans price action in real time, detects the fair value gaps, and plots the balanced price ranges on your chart. And the best part? When price retests these zones, it'll signal you so you never miss a trading opportunity. Here's how you can add it to your chart. Open up TradingView, click the indicators button at the top, search for balanced price range, and click on this one by Flux Charts. It's completely free, and there'll also be a link in the description for easy access. The indicator will load instantly, and you'll see the balanced price ranges highlighted right on your chart. Now let's walk through the settings so you know exactly how to fine-tune it. Starting with the sensitivity. This controls how many and what size balanced price ranges appear on your chart. Higher values will only detect the larger, more significant zones. Lower values will pick up every small move, even minor fluctuations. If you want to focus only on strong, obvious ranges, raise it. If you want to see everything the market forms, set it to 0. Next is the detection method. This determines how fair value gaps are spotted. Same means all 3 candles that form the FVG must be in the same direction. 3 bullish candles or 3 bearish candles. Mixed only detects gaps formed by a combination of bullish and bearish candles. And all includes both types of FVGs. For cleaner and more reliable zones, start with same. If you want broader detection, switch to all. Then comes the invalidation method. This tells the indicator when a zone is officially broken. You can choose wick or close. If you select wick, a simple wick above or below the zone will invalidate it. If you choose close, the candle has to close beyond the zone before it's considered broken. There's one invalidation setting for fair value gaps and another for balanced price ranges, so adjust them based on how strict you want your rules to be. Next, check the retest setting. When it's enabled, the indicator will mark small triangles on your chart whenever price taps back into a zone and reacts. Green triangles for bullish zone retests. Red triangles for bearish zone retests. This is great for spotting confirmation entries without watching every candle. Finally, you can set up alerts to make sure you never miss a setup. Scroll down to the alert section, enable the ones you want to receive. You can choose between a new bullish BPR forming, a new bearish BPR forming, and their retests. Then right-click on your chart, click Add Alert, select the BPR indicator, choose any alert, and click Create. From then on, you'll get notified every time one of your chosen conditions triggers. Now that you've got it configured, let's see how to actually use this indicator to find high risk to reward setups. Here's the strategy. It's simple, but when used correctly, it's one of the most powerful setups you'll ever trade. You're combining 3 key elements: higher time frame trend, liquidity sweeps, and balanced price range retests. First, start with the higher time frame. Switch to the 4-hour or daily chart and determine the trend. Is price moving up or down? If up, we'll only look for long trades. If down, short trades only. And if price is moving sideways, 0 trades. After determining the trend, mark your key levels: previous day, highs and lows, weekly highs and lows, and major swing points. These are typical areas where stop losses are placed. Next, wait for a liquidity sweep. Price pushes above a key high or below a key low, triggers the stop losses, and reverses back. That's your sign that smart money just stepped in. Now drop down to your entry time frame and watch for the BPR indicator to detect a new zone. That's where the market found short-term balance after the shift. You don't enter yet. Wait for price to pull back and retest that zone. In a bullish setup, it dips into the BPR from above. In a bearish setup, it rallies into the BPR from below. On that retest, look for confirmation. It might be a clean rejection candle or confluence from another indicator like the RSI. Once everything aligns, the trend, liquidity sweep, BPR formation, and retest, that's your entry. Your stop goes just beyond the BPR boundary. Your target is the nearest key level. Tight stop, clean logic, defined risk, massive reward potential. That's precision trading. Let's take a look at how this plays out in both directions, starting with a bullish setup and then a bearish one. We'll start with the bullish example. Here, we're on the daily chart in a clear uptrend. Price pulls back and sweeps the previous month's low. It dips below the level, triggers stop losses, and snaps back up. That's a textbook liquidity sweep. Next, we drop to the 1-hour chart to find the entry. As price pushes higher, the BPR indicator highlights a new zone. You can see exactly how it forms. A bearish fair value gap appears during the drop, followed by a bullish one during the reversal. The overlap between those two creates the bullish balanced price range. Now, we wait for price to retest that zone. The indicator prints a green triangle, signaling a reaction. For added confidence, we confirm with the RSI to make sure momentum is turning back in our favor. Everything aligns, so we take the buy. Our stop goes just below the BPR, and our target is the next key level above. Price pushes off the zone and climbs higher. Pretty clean, don't you think? Now let's look at the bearish example. We're on the 4-hour chart in a clear downtrend. Price rallies into a previous high, sweeps liquidity, and reverses sharply to the downside. Bulls are trapped, and sellers take control. We drop to the 15-minute chart to refine our entry. As price falls, the BPR indicator detects a new zone. The pattern is the reverse of before. A bullish fair value gap forms during the rally, followed by a bearish one during the drop. The overlap between them creates the bearish balanced price range. Price retraces upward and tests the upper boundary of the zone. A bearish rejection candle forms with a long wick on top and a close near the low. That is our signal. We enter short at the close of that candle. Our stop goes just above the BPR, and our target is the previous swing low. Price breaks lower and respects the balanced price range perfectly. Another clean, high probability trade built on structure, patience, and confirmation. Let's talk about why this strategy works so well. You're not trading on hope. You're trading on structure, logic, and clear institutional behavior. The liquidity sweep shows you where smart money hunted stops and trapped traders. The balanced price range shows you where both aggressive buying and selling collided in the same zone, the exact level that institutions care about. And the retest gives you a precise entry the moment the market confirms that zone still matters. The balanced price range indicator makes this process systematic. It removes the emotion, finds the overlapping fair value gaps for you, and highlights every high probability zone in real time. And this is just the beginning. If you want to take things further, we've built a full suite of advanced indicators for traders who are serious about their edge. You'll get access to AI signals, multi-time frame price action features, powerful screeners, and even backtesting tools so you can prove a strategy before risking a single dollar. You can get instant access to all of these tools today at fluxcharts.com. There's also a link in the description. That's all for this video. If you learned something new or got value from it, hit the like button, drop a comment to let us know your thoughts, and make sure you're subscribed so you don't miss the next one. Thank you for watching, and until next time.